First of all, though, let's do a poll. I think you're all poll experts by now. InvestLondon.app, in case you've forgotten in the break. And please, let's do this poll, because I think it's a good one, because you, the audience, are going to be judging the panelists from the off. And what is better than putting people on a platform and judging them on your mobile phone? So let's have a look at the panel. Given a 7-year time horizon, how much of your money would you put into VC right now? That is not a great start for the panelists. Wouldn't touch it. At least some people are shooting for the moon. That's good. Maybe we should do this at the end of the panel, and then we'll see what happens, yeah? We'll have to dabble. We are in Europe, after all, perhaps. OK, great. It's still going? OK, so about 5%. Before I start, I mean, obviously, none of you lot are going to say that VC is a bad investment, right?
Absolutely not.
Right, just checking, just in case. But this is an interesting way to start, I think, because returns obviously a key point, and at the heart of investment is about expected return. But with venture capital, there often isn't a lot of information to base your predictions. Now, Ophelia, obviously, I'd like to start with you. You've been doing VC for 10 years, is that about right? Focusing on early stage investment. You recently raised a new fund. Obviously, a lot of money has been flowing into VC. Valuations are sky high. The disconnect between private and public valuations is increasingly stretched. But I'm kind of interested at the very beginning, C and Series A, and a little bit beyond, about how these valuations have impacted on the attitudes of the founders when they're starting out right now. Are they waltzing into the boardroom and thinking, hey, I can demand loads of money because look at the people ahead of me? Or are they thinking, OK, this is a pretty scary time to start a company. Maybe there's a bubble. Like, what's going on there?
I think founders are less concerned there's a bubble. I think it's easy to look around and look at your peers and see kind of how much they're raising and what valuations they're raising at and try and benchmark yourself to others. And then it falls into the category of kind of rash, reasonable founder who has kind of competent mindset as to what they're building versus others who are kind of in the glory days of figuring that they can try and achieve the same with not much that's been proven. And so I think our job as an investor, obviously, is to try and make sure that we're partnering with the right founders, those who are kind of clearly set on how they want to build their business, the required runway and capital that they need to do that, and be steadily increasing their valuation as they kind of de-risk the model of the business that they're building. I think that in the end, most founders kind of come to see reason when they go out to market. And you can always try for those lofty valuations, but most VCs are quite disciplined in their approach to investing. When you do see those kind of crazy rounds, it's normally for a premium asset that people are kind of desperate to get into now because they know that they're buying for what's to come in the future. And so I think there is, some kind of a lot of craze in the market, but I'd say that we tend to partner with those who are quite rational and don't want to have their businesses overpriced at this round, recognizing they'll only see the fallout of that at the later round.
How do you manage that tension, though? Because imagine if someone comes in and sees you and is pitching to you, and you're thinking, this is a really good business, but these people are lunatics. Like, they think their business is way overvalued. Like, how do you balance that? I don't want to miss opportunity, but I don't want to back someone who's obviously crazy.
I think it's obviously a discussion between us and the founders to explain the risks of raising ahead of yourself right now. So, when businesses start to have meaningful revenue, you can obviously apply public comps, whether it be a marketplace comp or a SaaS comp, and you can kind of explain that if they don't hit that revenue trajectory, there's going to be a down round or some kind of fallout of what looks good now will look very bad in the future. And again, I think most reasonable founders come to understand that. Having a down round is not good for anyone involved.
Mm-hmm. OK. So, Ibrahim, I just want to move to you and get your thoughts on this. So, Ophelia's doing the hard work of finding the founders. Obviously, you do both. You do obviously large-scale investing with Mubadala, but also you just started doing more early stage investing and mid-stage VC investing. And you raised a $400 million fund focusing on European tech last year. So I kind of see you as kind of like the more mid-school teacher, like maybe private tutor. For example, you're giving startups their first sizable lump of capital. How has the increase in valuations changed how you're going to allocate your money over the next 5 to 7 years?
So we are an LP in Ophelia's fund. If I can share that, Ophelia. It's called Blossom Capital, so I can promote you a little bit. And obviously, we like how she looks at founders and evaluates founders at that early stage, at the seed and the A round. That's an important part of our strategy, which is around how do we leverage the skills and capabilities of an early stage investor and of a really, potentially a really good early stage investor at the seed and the A round. The reason why we've launched a 400 million euro fund here in Europe with strong collaboration from Softbank is because we really saw a major gap in the market for what we saw in what we call growth and early growth in tech. There is in Europe generally, if you really study the venture market here in Europe, there's a real gap in early growth. Softbank experienced that over the past 2 to 3 years, where they just didn't see sort of really good companies that were able to invest capital into. So we saw an opportunity for us to position ourselves where we can partner with Ophelia at the early stage, and we can also partner with Softbank that came in at a later stage. I think to your point around valuation, there's this, all of a sudden, there's this perspective where unicorns are bad, and everybody should not use the word unicorns, or everybody hates unicorns. I just feel like that's like a city perspective. We don't understand that perspective. At the end of the day, the public markets have taken a view and have really evaluated these companies based on management, based on strategy, and based on execution. So whether you are a unicorn or you're not a unicorn yet, or you are a decagorn, if you have a business and a strong management and a clear strategy and you're executing, the public markets will reward you for that. There's this lots of talk between the disconnect between private and public valuations, and yes, all private investors have their own methodologies in terms of how they value companies, but that doesn't mean that we should just apply so much noise to this disconnect between private and public, or all of a sudden go from we all want to invest in unicorns to we should all stay away from unicorns. I think there's great founders out there with great companies, but it just goes back to fundamentals, and I think it's really pushing us on the private side to, again, go back to fundamentals, which was much needed.
So what do you think you can do better then? Because I'm a journalist, I like blaming people. It seems I've got to blame someone for the fact that some of these IPOs do really badly, some do fantastically. Obviously, there's perhaps a narrative that maybe the media's got partly to blame, but also there's an obvious narrative that late-stage investing and perhaps mid to late-stage investing and these valuations had to blame because everyone is valuing companies with different metrics. So just go back to what you said about we're afraid of unicorns. How are you going to make people become accepting unicorns again, accepting you can have these very high valuations for companies that might knock it out of the park?
So again, I believe it's got to go back to fundamentals. If you look, I think Wall Street Journal published an article recently that showed in 2018, 25% of all tech companies that went public were profitable. The last time we had such a low number was in the year 2000. So that's quite low. I mean, I think there's companies, tech companies and startups and even growth companies now have to start pivoting to become much more focused on fundamentals and profitability and building a real business. We went through this past decade of what we call online to offline or offline to online, companies that help you live and ride and sleep and eat and travel. And obviously with a significant amount of capital, I think we got ahead of ourselves. So now I think it's time to go back to fundamentals, especially in Europe. I mean, talking about late stage, in Europe, there's a real problem with late stage, with growth capital, because there isn't none. Companies struggle in Europe to go from the A's and the B's to the early growth. There is no capital. There are no investors. There are some investors, but there's no investors at scale that are enabling these companies to really access these investors at this stage and be able to grow and go public after that. I think that's a major gap, and that's a part of our strategy. But we also worry that all of a sudden, this environment that's been created is causing these late stage investors to shy away from the stage, and I think that's wrong.
Okay. Well, one late-stage investor that's not really shying away is Softbank, I think. That's fair to say. I mean, obviously, your late-stage investing, we've got early and mid-stage. You're kind of like the university stage. You're paying lots of money to send your kids to university. But there's a risk they might run off and spend all their money on a private jet going to spring break or something. That's a big fear for you, but obviously we'll get back to WeWork in a minute.
Not my kids, though.
But seriously, it seems difficult, and this is what we're perhaps getting stuck on. It's difficult for private and public valuations right at that key stage between private and going public. And that's the thing, obviously, you have to worry about because you have to worry about returning to your investors. So what are your worries at the moment about the general investing public's perception of late stage startups being overvalued?
Yeah, great question. And first, let me start by saying that we too are LPs in Mubadala's venture funds, both in the US and Europe. So a little bit of promotion for
Thanks, Saleh.
Ibrahim.
Just like energy flows.
We as in Softbank Group, not the Vision Fund. But great question. I think it's good to provide the audience with some context, right? And since 2008, which I think most of the members of this audience have experienced, we have lived in an era of massive synchronized, monetary easing, right? Both in the sense of monetary policy, low interest rates, it's been a race to the bottom, and massive amounts of quantitative easing. So the context in which we're coming, both in the public markets and the private markets, is one of immense liquidity, let's face that. And clearly in the private markets, I mean, the simple law of economics, right? Supply, I think, of money, supply of cash has outstripped demand to a certain extent. And I think in very simplistic terms, we've had that effect, and hence some of the valuations that we've seen. There's no secret about that. I think that's what's happened. I think also if you compare the private markets and the public markets, in the private markets, we've tended to focus more and emphasize more the growth metric much more than kind of hard cash flows. The public markets eventually gravitate towards comparables. And if you're using comparables, eventually you're going to look at things like cash flows, profits, et cetera, right, which are more concrete. So you've had that dichotomy in the way the two markets kind of value companies. The key is for the two markets to start converging. And here, the Vision Fund at least, we're keeping a very close eye to make sure that while we emphasize growth, there is a path, as Ophelia mentioned, to profitability, right? We have to have some visibility, some path to profitability, so that at least we can begin to make sense of some of the valuations. But it's, I'm not blaming monetary policy and central bank governors for this, but it is a fact that we've lived in a very low interest rate environment. The outlook continues to be the case. If you look at most yield curves, they're very flat. I'm a fixed income person by background. I like to think of it in those terms. If you think of most venture companies, most early stage companies, they typically don't have cash flows for the first several years. So when you're valuing those companies, you tend to look more at kind of the exit multiple, right? So if you look at it just in terms of distribution of cash flows and value, it's much more weighted at the tail end, right? So in fixed income terms, we call that long duration. And of course, with that long duration, low interest rates tends to amplify that valuation. So I think there is a phenomenon of just the overhang of general macroeconomic conditions that have led to that. I think it's important for investors to keep an eye on that and to make sure that there is an orderly transition to becoming a public markets and that it fits, the public markets criteria to value a company. So
I just put you on the spot then.
Yeah.
Would you, in hindsight, given what you're saying about this focus on profitability and also this macroeconomic environment, would you have invested as much as you did in WeWork and Uber, or would you have done it differently?
Yeah, you are putting me on the spot for that. Let me, hindsight's 20/20, of course. I think the best way to address that is to first think of it in terms, Ibrahim mentioned it, in terms of being able to incubate a company long enough so that it's starting to earn cash flows and then that's ready to go to the markets. Arguably, one can say some companies should go to the market a little bit later, right? So I don't think it's so much a question of quantum as it's more of a question of when is the right time for a company to become a public company, right? And I think that's one of the important considerations to take into place. One can say that there are some companies out there that are probably better to evolve in the private domain, right? And kind of improving their business model, improving their unit economics, and getting to a point where it can actually demonstrate, ultimately, it's free cash flows that investors want, right? So getting to that point, and I think at that point, it's then ready to be valued by the public markets using the same criteria that we would have used.
Ophelia, does it sound like to me it's like a great time to be an early stage investor because you can just sell your stake to these guys, right? There's high valuations, you've got a really good capital market right now, or am I massively oversimplifying it? Is it a really bad time to be an early stage investor because you don't know what's going to happen in the macro environment? Who knows how it happened with all the capital coming into VC? It might just disappear. Which one is it?
So when we invest, especially at this kind of peak in the market, we're always thinking about how our businesses will fare in case there is a recession or an economic downturn. And that's less about the capital that's going to inflow into the company, but more so, how will they make revenue in those times? And so you think about how consumer spend patterns will change or enterprise spend will change. And so there are certain, as an early stage investor, we think it's prudent to stay away from certain sectors that are very cyclical, like construction software or HR tech that look really good now, but if there is a turn in the market, obviously they're going to be impacted. And as an early stage investor, you never want to be investing into shrinking markets. So that's kind of how we see it from our pure investment point of view. Then when we think about follow-on capital, we have to believe that these companies are going to ultimately grow big enough to be public companies. And so we're not actually looking to sell into these rounds. We think it's a great bonus to bring in brilliant investors and have more capital. But ultimately, we are looking to create the next generation of public companies. And for us, we're not determining the valuation at which they raise. You spoke of supply and demand. Investors are looking to invest in the best companies. And sometimes, when you have multiple great investors trying to get into a company, that's when valuations start to be inflated. And they're kind of paying forward to be in the business now because they believe that, should they wait a year, the price will only get more expensive if they demonstrate all that they're going out to do. We encourage our founders to be rational when they're coming to these raises, and I would say that the majority of them are, but of course there are rounds that get highly competitive, and I think that's where you see the increased valuations in the market.
Okay, just actually you touched on my next question in terms of obviously there are links between everyone on the stage here. Is there an issue of groupthink right now in venture capital, the fact that it is quite intertwined, or is that a benefit? The fact that it's much more, seems to be much more. I used to cover banking and asset management, and it seems very, very cutthroat. And I covered a VC, and it suddenly seems like everyone's each other's friend. And is it really like that? Is it good to have all these connections, or does it mean that you all jump into the same estate together?
So the early stage, we call it co-opetition. Sometimes you collaborate, sometimes you compete. And I think that kind of dynamic is healthy. I think the beauty of early stage venture is you're trying to see something that no one else is seeing. That's how you go and invest in outliers, because you've believed something that lots of other people don't. And so actually sometimes, you find that you don't have competition, and that may be a good thing. Especially within our own investment committee, when we're making decisions, we very much do not look for consensus, because we want disagreement among ourselves, because then we think that we're kind of seeing an outlier. At the growth stage, it's harder to say that you're seeing something someone else isn't seeing, because there are metrics, there are KPIs, there's revenue. You can judge how a business is growing. So you may deliberate over the quality of the management team, you may deliberate over the strategy of the business and where they're going and whether they're actually capable of, but it's kind of harder to disagree so much, and that's where I think you get much more competition for the rounds.
Okay. I was going to change it slightly to talk about personnel, because obviously the first poll we had, there was quite a lot of skepticism about VC, and it's interesting to see the sort of the people that are now moving into VC. I think, Saleh, you're obviously a former banker, as you said, at Goldman and Deutsche, and Ibrahim, you were a CEO and an M&A banker. Is that right? Or fair? Sort of. Business development manager as well. As Ophelia, Europe seems to be a VC investor through and through, but you've got the Chief Technology Officer at Formula Delivery, right, working for you, and you've also got someone from Bloomberg, so there's hope for me after this panel, which is good. I'm going to ask, actually, Ibrahim, I'd like to ask you first, who do you think is the best at becoming or being a VC? Do you think it's the former bankers? Do you think it's the operators like yourself? Do you think it's the straight VC investors? And you can't say a mix. You've got to persuade the audience. For example, let's imagine it's like some sort of horrible reality TV show, and they've got to give you money at the end of this. So like, who do you think's the best pedigree for being a VC investor?
I don't know. You know, listen. In the U.S. I don't know if there's a best. In the U.S., Bill Gurley from Benchmark, who I admire a lot, respect a lot, he was an investment banker. Michael Moritz at Sequoia was an author, was a writer, you know, and a journalist. One of my favorite funds today in Silicon Valley, Haystack, he's also a writer. Listen, at the end, I mean, you know, when we invest in funds like Ophelia's, we really ask the real hard questions around how is Ophelia finding the right founders, how is she evaluating the founders, and how is she going to support the founders when these founders wake up every day on the verge of their companies going out of business? How is she going to support them? Because I think VCs fall into three categories when their companies don't work out. Number one, they either freak out and start calling every day, what's going on, what's going on. Number two, they just never call or appear anymore. Or number three, they really engage and support these companies. And I think the right VCs have to make a decision between when they can step in and step out. So I don't know if there's best. You know, we see many great investors with different perspectives, different points of view. I think the really good investors find the right winners and they stick to them versus, you know, obviously you have to be also proactive around how long do we hold and when do we exit. But ultimately, the really good investors stick to the winners because this is an outlier business. I also want to, if I may, speak a little bit about the founders because I think, and maybe you're going to take us there at some point, Giles, but I think the founders, especially in Europe, you know, we've been now in Europe meeting a significant amount of founders, and I think there are exceptional talent in Europe where when we first started in Silicon Valley, we never really, first of all, heard, or there was always this perception that European founders just don't know how to scale and they don't know how to execute as good as the American founders or the Chinese founders. I just don't know if that's true. We just invested in a company called Tier, which is a scooter company. We call it a micro-mobility company, whatever you want to call it. But the initial reaction was, why are you investing in another scooter company? Well, we invested because this is an exceptional founder who had spent a significant part of his career running operations and building very operationally complex businesses. So bringing that operational knowledge and complexity to this business, number one, being able to attract talent and being able to articulate the long-term plan of a business is critical. And how he's able to sort of garner a whole diverse set of investors, because that's going to be really important as he scales and grows the business. So, you know, I think from a founder perspective, we're seeing great founders in all over Europe, not just in the UK. We're seeing them in Germany, we're seeing them in France, and there's something special both from a technical perspective and an operational perspective in founders in Europe. I remember reading one of Ophelia's reports, and I saw that she made an investment in this fintech company called Checkout, and I was like, wow, Ophelia, why did you invest in this company? This is a founder that lives in Dubai but travels every week to Europe, and he had not raised money. He had just done his first round. He's been running his business for nearly a decade, profitable, and he had not raised a dollar from investors and just raised a major round from Ophelia was one of the investors. So I think European founders with their very strong lens on fundamentals and achieving profitability, I think there's something unique that we should just pay attention to that's happening in Europe that I think we lose amidst the noise.
Okay. Saleh, I'd like to go to you for just a bit, and the title is obviously Pushing Boundaries in VC. Now, everyone thought your first $100 billion fund was pushing a few boundaries, but you decided to go out and try and raise another $100 billion fund. Like, how's that going, and do we need another $100 billion in startups right now?
Yeah. Well, let me provide some historical context, right, as to why we started Fund 1 in the first place. Softbank Group, the corporate, has had a history of investing in companies, right? It's an operator. It used to be an operator of multiple companies. You had Yahoo Japan, you had Sprint in the US, you had SoftBank Mobile in Japan, amongst others. And it had a significant investing business alongside that. The reason we created the Vision Fund, and I was lucky enough to be involved in that process with my partner Ibrahim here, the reason we started was that, simply put, SoftBank Group just ran out. The ambitions and the vision of Masayoshi-san outgrew the balance sheet of the SoftBank, the corporate. So the fund was a better vehicle to express that vision and to express that strategy. Right? And we were lucky enough to be able to partner up with Mubadala and the PIF, alongside a couple of other strategic investors, to start Fund 1. That was the beginning. But you have to remember, Giles, that we are just on the cusp, just on the beginning of the real technological revolution. Right? Why? Because right now you have the confluence of the speed of transmission of data, the ability to store it in the cloud, and importantly, the ability to process that data using artificial intelligence because of the capabilities of AI today, right? Which means that we're just at the advent of a number of technologies that are going to transform traditional industries. I mean, think of something that all of you use every day, like transport. For many, many years, right? We used taxis as a traditional form of transport. You now have rideshare that has upended the way people move about, right? And that's only the beginning. If you think of what technology has influenced in traditional sectors, certainly advertising has been disrupted and changed, right? Retailing, commerce has been disrupted, but you have so many other sectors that are ready to be disrupted and changed and improved, all for the benefit, ultimately, for consumers.
Do you think some of these trends? Do you think some of these trends can avoid what's happening with geopolitics at the moment? For like a good example, overnight we had Donald Trump putting a bunch of Chinese companies on a blacklist. One of them was SenseTime. It's a company you've invested in. It's got a 7.5 billion valuation. I mean, the idea behind SenseTime, you could argue, in the long term is fantastic, but in the short term, how do you manage a geopolitical risk that something's going to happen between the US and China that just torpedoes your dream?
Yeah, I mean, I think when you're involved in a global business of any kind, investing or otherwise, you're always going to face systemic risks, right? Whether those are trade tensions, geopolitical risks, economic cycles, you're always going to face those. I think what's important is that with the scale of the Vision Fund and the patience that we have, we're able to see companies through those ups and downs effectively, right? I think that's what's important for us. Sure, most of the businesses that we're invested in, particularly the big platform businesses, are ultimately consumer-facing, so they tend to be, all things held equal, pro-cyclical. Many of the businesses that we're investing in are becoming completely global. We've taken companies that have emanated out of India, that have emanated out of different pockets, and made them global. That's part of the ecosystem, and that's part of the value proposition that we offer our investee companies. So invariably, yes, they are pro-cyclical. They're not going to be immune to the vagaries of economic cycles or geopolitical risk. I think the important thing is to be able to pick the companies, the number one companies, the winners that are best suited to kind of ride those events through. Right?
And venture is not venture is not short term. It's not a short term business.
Yeah. I
mean, as venture investors, it's a 10-year cycle for us to really learn whether we've made the right investment decision. I mean, this is a long-term business.
Yeah. And
I think, by the way, this cycle, my view is this cycle is going to do two things. There's two sets of investors that I think what's happening today is going to clear out. Number one is what we call the tech tourist investors. So SoftBank has been investing in tech for the past 30 years, and we'll keep investing in tech.
Yep.
Mubadala has been investing in tech for 10 years. We will keep investing in tech for another 10, 20, 30 years. So I think these investors that came in, I'm sure many people here in the room are tech investors. And the other set of investors is what we refer to as the founder-friendly. Over the past 10 years, we've had the emergence of what we call the founder-friendly investors. That means no matter what you do as a founder, we will support you. And the first firm to actually stop that was Benchmark Capital with Uber. And I think we're now moving to, listen, there's a difference between founder-centric and founder-friendly, where I'm going to support the fund, but at the end of the day, I'm your shareholder, I'm your investor, I represent the shareholders, the common shareholders too. You have your role as a CEO and as a manager, and I think that these two types of investors, I think, is going to clear the path for the real tech investors.
So I have to ask you though, are you going to invest in the next fund? Are you going to continue this journey?
We are evaluating it. We'll continue to evaluate it. I can't answer yes or no whether we'll invest in Vision Fund 2. We are partners to Softbank. We'll remain partners to Softbank. We're very focused on the performance of Vision Fund 1. We work as a 5% holding in Vision Fund 1. There are 80 other companies in Vision Fund 1. So, it's just important. We invested in a fund, which is a portfolio of companies versus investing in one company.
Okay. We're just run out of time, so I want to thank you for my panelists. Thank you very much for making your time, and thank you for the audience for listening. Thank you very much.
Please welcome to the stage Church Commissioners for England Chief Investment Officer Tom Joy, APG Asset Management Managing Director Global Responsible Investment and Governance Claudia Cruz, Credit Suisse Global Head of ESG Strategy, Impact Advisory and Finance Daniel Wild, and Bloomberg News Sustainable Finance Editor Emily Chasen.
Hence the need for the makeup.
Hi, everybody. Thanks for coming out this afternoon for our panel on ESG and sustainable investment. I'm the Sustainable Finance Editor here at Bloomberg, and we've been covering sustainability and ESG for the past 4 years and just seen the space explode, right? There's over 30 trillion in assets that are some sort of criteria for ESG today. So we have a wonderful panel here, and they're going to get you all excited about what they're doing and how they're rethinking investment. Let's start with a poll. Can the poll come up? Everybody get your poll things ready to go? So our question is, how do you define your approach to ESG and impact investing if you have one? And here's the questions. It adds value. It's important to advocate for social and environmental issues. Or I'm indifferent for now, and I'll see if I dip my toe in the water. While we're waiting, maybe we can ask the panelists, have you dipped your toe in the water, Daniel?
A long time ago, yes.
And how do you see it evolving, this space, from Credit Suisse?
I think the exciting time we are living in is proof that many developments come together right now, positive developments.